And Jared, I know you've been watching these oil moves really closely. We've seen a bit of a pullback from those highs that we just mentioned, because there's still questions here about, number one, how united European countries are going to be in banning oil and gas, obviously, given just how much more reliant they are on that. But JP Morgan putting out what I would say is a pretty surprising number here, saying in an extreme upside scenario, Brent could go up to $185 a barrel.
It's pretty amazing to just consider the price movements here, and we're still in the thick of this, and this is very much a headline-driven market. And we go to the Wi-Fi Interactive. I just want to show our commodities heat map for the day, where I'm going to continue the discussion about oil, but I just want to point out that our nickel, this is our nickel index, is up 62% today. So I think all of this is because there's not only a conflict in the Ukraine, of course, but also because the market was already primed for this. We have the Federal Reserve fighting the highest inflation in 4 decades. And it's not a surprise then that we're seeing some of these gyrations play out in the commodities market. Fortunately, we have Dan Dicker here, a veteran oil industry trader and expert. He's going to shed some light on this. But we could have been facing a supply shock. I have to say, even if we did not have the current situation, could have been a terrorist attack with respect to Saudi Aramco, as we've seen before. But watching this play out in the markets, I think it's going to be very key, because under normal you might have seen a $5, $10, $15 price effect. And in the current environment, we're seeing that magnitudes of order greater, Akiko.
Well, and Jared, it's important, I think, for our viewers to kind of take a step back here to say why we're so focused on these moves. Obviously, because of the huge spike that we've seen. But when you look at Russian oil and gas, it accounts for 12% of global trade. 60% of Russian oil is exported to Europe, which is why, of course, the president has said very clearly that as the U.S. considers a ban, they also want to be mindful of the impact any kind of ban would have on its European allies. China, of course, a big player here as the single largest buyer of Russian oil, buying up 20% of exports. And then we've also got Russian gas here. Of course, countries like Germany, very reliant on those imports. Russia is the world's second largest gas producer, accounting for roughly 20% of global output. And I want to note one more thing, Jared, because I know this is something that a lot of Americans are watching very closely, and that is how average gas prices have spiked alongside with this. And that really is going to be the big test, at least for this administration, as they try to brace Americans for what could be higher prices here. $4.07 is what we're looking at in terms of the current average. Let's bring in Daniel Dicker, the Energy Word founder. And Daniel, as Jared said, you are the expert watching this one very closely. Let me ask you what you think the impact would be on any kind of ban on Russian oil and gas, especially given that by some estimates, there's more than 60% of that supply that is likely to be stranded because there is self-sanctioning that's already happening in the market.
Stranded is the wrong word to use here. I would say curtailed is a better use of the word. What you're looking at is you're looking at an oil market that goes into the dark shadows if it gets banned. That has a significant effect on the Russian economy, but it doesn't really have a big effect on supplies. Petrodollars flow. Petrodollars always flow. I've been in this business 35 years. It doesn't matter what war breaks out. Oil finds a home somewhere if there's, a market for it. And there's a market here. We've seen already China has been buying dark supplies from Russia. We've seen Shell, in fact, buy a dark supply of Russian Urals cargoes at a deep, deep, deep discount. So, in fact, what you're seeing in the oil market is more of the threat of what these curtailments would mean, as opposed to a fundamental kind of extra supply shortage that's being put into this market. Russian barrels will find a home, but that does not minimize the impact that banning Russian oil from the regular markets would have on the Russian economy. It would be enormous and really important. And I salute the Biden administration for taking this on. It's a political nightmare, obviously, because gas prices will go up, and that's always terrible for a sitting administration. But if you really do want to get at a major creator of Russian revenues, you could do no better than to hit on oil and gas. It's really what has powered the invasion, and it powers the Russian government. And when you hit that, it really matters.
Dan, I was listening to you on our live program. I think it was only 2 or 3 weeks ago where WTI was hovering around $95 per barrel. And I think at the time you expressed a little bit of surprise that it had gone that high. And of course, it's gone much higher in the interim. Now, JP Morgan calling for $185, as Akiko said, in an extreme situation. I'm just wondering where you see the prices finally finding some kind of equilibrium here.
Yeah, Jared, this is always the toughest thing. I mean, I've seen oil markets go parabolic 4 times since I began trading in 1986. And in all of those occasions, it's really tough to pick a top. Once markets go parabolic, speculators come in, a lot of uncertainty falls into a marketplace. From a fundamental point of view, there is nothing, even a major curtailment of Russian barrels, there's nothing that would fundamentally make oil go up to some number like $185 or $200 a barrel. But in fact, the emotion attached to futures markets and the panic that could erupt in futures markets, of course, could send it to any number. So for me, I don't really look to, call a top here. It's difficult to know, for example, in 2004, what that oil would trade $150 a barrel in 2007. So, I'm not going to try and do it here. But I do know that once these markets do go parabolic, it's really very difficult. Prices can get very high in a hurry.
Dan, what does this ultimately mean for energy producers here in the U.S.? I mean, you've heard the cynical take here, which is that output hasn't necessarily increased in a significant way, largely because high prices are good for these companies. How quickly can they increase the tap, if that's the right way to put it, to be able to meet the demand that is out there if Russian oil and gas is taken offline?
Okay, so this is a very complex question, very difficult to answer very quickly. But first, we have to remember that oil was negative $35 a barrel in April of 2020, not that long ago. So what you have is you have an American oil infrastructure that's been decimated by low prices for the past 4 years. So in terms of their ability, their capital position to quickly ramp up supply, it's not there, and it hasn't been there for quite a while. So that's the first problem. The second problem is that in all of the ways that U.S. oil producers generate, create reserves and bring them to market, only shale has the ability to ramp up at any kind of speed. But even that requires 6 months for new wells to be driven and drilled and for supplies from them to be delivered. So again, it's a slow reaction. It's going to happen, obviously. Nothing solves low prices like, nothing solves a surplus like low prices, and nothing solves, a shortage like high prices. But that takes time. So I would not expect the American oil industry to immediately respond, in producing at a breakneck speed. They can't.